In this video, I'm going to show you two different ways to get into the market like a pro for high win rate and high risk reward trades. Let's get into it. So for entry number one, we are looking at Euro USD, and this is a trade that I took with my team. Now we're looking at the hourly time frame, but this entry model can be used pretty much on any time frame, whether it's the 1 minute or 5 minute for low time frame trading, or the hourly or 4 hour for swing trading. It doesn't matter, the patterns are going to be the same. Now an important note before we get into the entry model here, this entry model has to come from a high interest area. So regardless of what your strategy is, this should be coming from supply and demand zones, major reversal points, key psychological levels. So before we go any further, I just want to let you know I've got a new free training. It's 40 minutes long and it's going to show you why you're not winning, and it's going to open your eyes to a new perspective of the markets. So if you want to stop being a losing trader and join the small winning percentage, then make sure you click the link in the description and sign up to this free training when you finish this video. Let's get back to it. So for this trade, we are in an uptrend, and the trend is very important because this entry model relies on trend structure. Now we can see that the market is uptrending overall, and having hit this demand zone, we would then want to go to the lower time frames. So for this example, I'm going to go all the way down to the 5 minute. And what I'm looking for here is for structure to actually go bullish, because we can see on the pullback, the market has gone down. So even though on a higher time frame, we are moving to the upside, on the lower time frame, we are actually moving down at the moment. So for this entry model to come through, what we're looking for is for the low time frame market to also go bullish with the larger trend. So here we can see the market form a lower low, lower high, lower low, lower high, and then another lower low. Now how this entry model works is actually catching the start of a low time frame trend shift. So here we can see that after forming this lower low, we pushed up to this point, and this has actually formed a higher high, breaking us above this point of structure. So this is the first half of the entry model. We've had a break of structure down here on the low time frame, and that shows us that the market is shifting from this downtrend into an uptrend. So now what we would want to do is find a high interest reversal point to actually buy from. For this particular setup, looking at the 5 minute, we are going to use this 5 minute demand zone just here. So a demand zone or a supply zone is essentially a small area before a large move in the market, an area of indecision or sideways price action. As you can see here, we had a sell off, then we had the sideways move, then we had the big push up. So this would be the demand zone we want to focus on. And these demand zones or supply zones, if we are trading to the downside, are going to be the points of which we actually execute our trades. So for our entry model here, what we would do is buy on this level, and we would put our stop below the low. The theory behind this is that the market should not trade under this level once again, unless of course we are wrong about the setup, and then it will unconfirm itself and we'll take the loss. But as long as the trend can stay intact, we are getting a prime entry to a nice reversal trade here. So now let's watch the process of this playing out. And as you can see there, price tapped into that level and started pushing to the upside. This gives us a high accuracy setup because we have the high time frame and low time frame trend in tune, and it also provides really good risk versus reward, because if we risk $100 on here, even with this very small move, which is only the start of the larger move we're looking for, we would already be up $200. So now we're going to lead through to entry model 2, and you'll be able to see the performance of this trade while we discuss the new entry model. Okay, so now we're looking at entry model number 2, and as you can see, trade number 1 is playing out nicely. We are moving to the upside from that initial execution, and can you see how accurately that tapped in and began to move? It's a really solid entry model to work with. But the second entry model is actually one that will allow you to get into trades during the momentum of a move. So now at this point, we already have the market shifting and trading to the upside, and we can actually see that the price is pushing at this high multiple times. Now, if you know me, you'll know I am a trader who does not really believe in support and resistance levels, because I know how these work. To many traders, this would look like a resistance where price is going to sell off. However, what I can see instead, now that the trend has shifted to the upside, is a level of which the price wants to break through and is continually pushing up. So for this kind of move, we want to find a resistance level or a support level that the market has attacked multiple times. And what we're looking for here is a breakout to follow the momentum to the upside. So there are two ways we can go about this. We can do this the simple way, and we could place a buy stop somewhere above price with stops below, and then if the market breaks out, it will trigger and hopefully follow the momentum to the upside. Now the other way we can trade this is to actually get a little bit more refined. As you can see here, I've shifted over to the 5 minute time frame, and what I'll be looking for here is a sign that this high is going to go. We can see within the current leg of movement from this low, we are actually forming very small higher highs and higher lows within this trending market. So if we can see price push at this high, that would be a really solid execution point. So we could go ahead with a buy stop at this level and stops below, and then if we break out, we are catching this momentum with a stop loss under the structure, so we have a safe place to get in. So now let's take a look at how this trade plays out. As you can see, the breakout here was followed by a large momentum push, which has driven our trade into profit. And now we have two entry models working together. We have the initial entry taken using that confirmation style approach, and we have the secondary entry using that momentum breakout approach. And now let's watch and see how these trades run out in real time. So here you can see the aftermath of entry model 1 and entry model 2 in the real market. Now, some important closing notes. It's important to understand that no entry is going to win 100% of the time. Entry models should be designed to have high accuracy and provide high risk reward when they play out. However, no entry model is ever going to work 100% of the time, so you have to manage risk. My personal trading strategy has around a 60% win rate, telling me that these entry models also have around a 60% win rate averaged out over the long term. So as always, risk control is key. That is all for today's video. If you have any questions, let me know in the comments below. I hope you've enjoyed it. Thank you for watching, and I'll see you in the next video.